when you see equity and fixed income both kind of taking a hit at the same time, pan out a little, right? Or zoom out, right? It's happening in the moment. But if you look over even a couple years, 3 years time horizon, they are still providing that diversification benefit. And so, as an asset allocation answer to, what do you do when both equity and fixed income are facing some headwinds? My answer is you, first of all, you still want to have both. They're still very good in the portfolio. They do diversify each other, but you do have to pan out a little and say, hey, how many years am I looking at this for, right? If I look at it for 3 years, I'm still getting that benefit. If I'm looking at it for days, weeks, maybe I'm seeing this higher correlation, but that's not a holding period. So 100%, you want to have those in most portfolios as the basic structural pieces. And then the other thing I would say is that we're seeing more and more use of alternatives to kind of diversify those two pieces. So I think when we talk about personalization at scale, it's very much about how we're balancing customizing portfolios with bringing efficiencies, right? I mean, we know advisors have always been customizing portfolios. They're very good at that. They know everybody's different. They have that person sit in front of them. Even if they put them in the same model, they know that that person has unique circumstances that may change how they interact with that model over time. But what we're trying to do when we talk about personalization at scale is say, okay, how can I build a really bespoke model for the client without needing it to be sort of Excel driven, idiosyncratic, requiring a lot of time on the advisor's part to not only build, but then manage. And so that's really what it's about. It's about the second half of it. It's about the at scale. And the way we're doing it, of course, as a wealth technology platform is we're applying algorithms, we're applying processes, we're applying things like direct indexing and tax overlay, where you set that up and then I won't say forget it, but certainly it's running on its own based on those customizations that you did up front. So as a CIO, one of the things that we oversee obviously in the portfolio management process is how do you look at sort of top down macro insights versus bottom up research? And a lot of that really comes at the phase where you're doing asset allocation, right? So when you're doing security selection or ETF and mutual fund selection, you're thinking about, okay, what are the fundamentals that I'm trying to achieve in this asset allocation? We're very big proponents of diversification. So we're not going to have typically very concentrated portfolios unless there's a real goal with that concentration. Maybe it's income producing assets. But the asset allocation a lot of times will be driven by an understanding that, notwithstanding the capital market assumptions and all the standard sort of updates that you get per year, most people are best served by a highly diversified portfolio because you don't know where the next volatility is going to be. And even systematic, I mentioned it before, right? Systematic volatility that kind of crosses the market, you're still going to be better off with some equity, some fixed income, and then sub asset classes within those to diversify the risks within that.